First of all, I would like to take this opportunity to thank you, Charles, and to thank the organizing committee for inviting me to this conference. It's a great honor for me to present you today the paper I have co-written with Loredana Uresh-Rango, which is entitled Home Sweet Home, Banks' Lending Characteristics and the Impact of the Financial Crisis. So, this paper is the logical following of the two previous papers because in this paper I study the credit supply provided by banks, especially after the collapse of Lehman Brothers. We pay a particular attention to this period because in the literature we have a very well-developed hypothesis regarding the fact that banks during a banking crisis tend to lend more to domestic companies. And we are able to confirm this hypothesis in our paper. So, after the collapse of Lehman Brothers, banks faced a confidence crisis. They started to be reluctant to lend money or at a very high interest rate. However, we may wonder what happens more precisely. What do I mean by that? Do banks cut their lending to all companies, or do they put a specific emphasis on some determinants? If yes, what are these determinants that matter when banks take their lending decision? So these are the questions we are going to address in this paper, because we really want to clarify what is the impact of the subprime crisis on banks' lending activities. We want to show what are the determinants that matters when banks take their lending decision. And finally, we study 4 different groups of banks located in 4 European countries to assess to what extent the geographical position of banks matters to explain the differences in banks' lending behaviors. The research questions we address in this paper are the following. First, as I told you, we want to determine in a general framework the significant determinants that explain why banks decide to lend money to this specific company. In addition, we want to check if we have a home bias, meaning if banks tend to lend more or to offer better credit terms to their domestic companies. In addition, in this paper, we have introduced a new hypothesis about a sectorial bias. We want to assess to what extent the industry of the borrower matters when they decide to lend money to a specific company. The ultimate objective of this paper is to be able to implement efficient measures in order to limit the risk of a confidence crisis and to decrease the risk of a credit crunch. Before I go on with the presentation, I want to provide you with a brief overview of what we have done in this paper. So, in the literature, the hypothesis of a home bias, a flight to home effect, is very well developed. Janetti and Levin have worked on the topic, studying the period after the collapse of Lehman Brothers. So, what do we do in our paper? We try to confirm first the hypothesis of a home bias using a different methodology, which is the joint estimation of 2 loans' characteristics, its spread and its amount. We introduce the hypothesis of a sectorial bias in order to assess to what extent the industry of the borrower matters. And finally, we control for all the variables which have been highlighted by the literature. One of the most significant contributions of this paper is the construction of the database, because we had to combine 5 different databases in order to get accurate and complete information about the 4 markets we are studying. The 4 markets we are studying are France, Germany, Italy, and Spain, and what do we find is that we are able to confirm the hypothesis of a home bias for the 4 countries, but with a difference. So, for France and Germany, the period of crisis under study is 2008-2013. We are able to confirm the hypothesis of a home bias for the whole period. However, for banks located in Italy and Spain, we are only able to confirm this hypothesis during the banking crisis. In addition, regarding our hypothesis of a sectorial bias, we are able to show that the industry of the borrower matters when banks located in France and Germany take their lending decision, and how it seems that these banks highlight a preference for portfolio diversification. So now I'm going to provide you with more details about the analysis we've used, the data, and the results we got from the estimations. So the objective is to study banks' lending decisions. So in our methodology, we want to estimate the credit terms associated to a loan. That's why we decided to estimate the spread of the loan as well as its amount. However, they can have an impact on each other. So we decided to estimate them in a system of two equations. And we have used the instruments to identify the system to define a credit supply equation and a credit demand equation. Our system looks like that. So we have two equations, one for the spread of the loan, one for the amount, and it's a cross-sectional estimation, not time series. So I'm just going to briefly provide you with an idea of the variables we have included in all the vectors. So the control variables are common for the two equations. So we look at the characteristics of the loan, the financial position of the borrower, the financial position of the lender, as well as the relationship that may exist between those two. Now, we have introduced the vector geo in order to answer our first question regarding a potential home bias in credit supply. So, in this vector, we account for the nationality of the borrower after the collapse of Lehman Brothers, and we want to assess the impact of this nationality on the spread of the loan. And finally, we have our two lists of instruments. So for each, we have two instruments. The instruments to identify the credit demand equation, so to look at the spread of the loan, are the government interventions that have followed the collapse of Lehman Brothers, as well as our second variable under consideration, which is the lender specialty. The lender specialty is how much the bank has invested in a specific industry and how this specialization impacts the spread of the loan. For the two other instruments, which are only related to credit demand, we consider the sales growth of the borrower as well as a dummy variable, which accounts for the fact that the borrower is involved in a package of loans. Now I'm going to show you very briefly how we got our data. So this analysis is based on syndicated loans market because it's a highly international market. So it's common for large banks to lend money to companies that are located abroad. In addition, it allows us to control for a potential flight to home effect. The four countries under study are France, Germany, Italy, and Spain because they represent the main economies in the Eurozone, and it allows us to make comparison between these four countries. Now, how did we proceed? We follow the basic principle that banks lend money to a company. Because we are dealing with syndicated loans market, more than one bank can be involved in a loan. For each step, we have used a different database. So to get financial information about banks, we've used Bank Scope. For loans, DealScan. And for companies, we had to combine 3 complementary databases in order to have a large sample to run the analysis. So we combine CompuStart, Orbis, and Diane. The principle, you start by determining the period you want to study. For us, it's 2005-2013. From DealScan, you can get information about the loans, as well as the name of the lenders involved in the loan, the name of the company, and some information. But this information is not enough to run the analysis. We had to combine the other databases in order to get first financial information about the lenders, as well as financial information about the borrowers. So that's how we got our data to run the analysis. Now I'm going to show you the results we got from this analysis starting with the hypothesis of a home bias. So, here we have the results for the vector GO for the period, the world crisis time, 2008-2013. And we study the impact of the nationality of the borrower on the spread of the loan. So the first observation you can make from this table is that in a general framework, after the collapse of Lehman Brothers, we have a significant increase in spreads, no matter the nationality of the company or the bank. Now, if we look into more details at France and Germany, we can observe that the increase is the lowest one, meaning that these banks in France and in Germany tend to offer better credit terms to their domestic companies. The explanation, the interpretation of this result is that thanks to geographical proximity, they are better able to get information and to assess credit risk. However, we are not able to draw the same conclusion about Italy and Spain, and this may be related to the fact that in the Eurozone at that time, we had in fact two crises, a banking crisis and a sovereign debt crisis, as Florian said. So we had the idea to disentangle between these two crises. So here you have the results for the same vector, but this time you have two coefficients per country, one for the banking crisis, one for the sovereign debt crisis. Again, we are able to show that for all the coefficients which are significant, they are significantly positive, meaning that we have an increase in spread after the collapse of Lehman Brothers. And this increase is especially higher during the sovereign debt crisis. Now, looking at France and Germany, we are able to confirm the hypothesis of a home bias, especially during the sovereign debt crisis, because at that time, the credit risk on sovereign debt started to be re-evaluated by investors, and banks located in France and Germany started to even more to reorientate their loans towards their domestic companies because they were located in a country where the credit risk on sovereign debt was lower. And this is confirmed by the increase in spreads provided by French and German banks to Italian and Spanish companies because these increases are among the highest one. Now, if we look at Italy and Spain, we are able to find an interesting result, which is the fact that we are able to confirm the hypothesis of a home bias during the banking crisis because we observe that these banks offer better credit terms to their domestic company. However, this is not the case anymore during the sovereign debt crisis because at that time, even Italian and Spanish banks increases the spreads on loans towards their domestic companies, which confirmed the fact that even banks in these two countries didn't want to or were reluctant to lend money to domestic companies. Now I'm going to follow the same structure for the analysis of our hypothesis of a sectorial bias. Does the industry of the borrower matter when the bank takes their lending decisions? So, again, this is the coefficient for the variables lender specialty. So, and this coefficient is taken after the collapse of Lehman Brothers. Here you can observe that the coefficient is significant only for French and German banks and is even more economically significant for French banks because for German banks the coefficient is close to 0 and is positive, which means that at that time, after the collapse of Lehman Brothers, banks started to think that their portfolio were not enough diversified. So they started to offer better credit terms to companies that belong to industries they are not used to lending to, which highlight a first indication, a first signal of a willingness to diversify their portfolio. Now, if we disentangle between the banking crisis and the sovereign debt crisis, we are able to confirm this result for the banking crisis. Because for the banking crisis, the coefficient is statistically significant and more, let's say, economically significant, while for the sovereign debt crisis, close to 0 for France, and not significant for Germany. Still, we do not have any significant result for Italy and Spain. Finally, for the control variables, the results are in line with the literature, and I want to draw your attention on the results regarding the financial position of banks, because we are able to show that banks with a strong financial position are better able to sustain credit supply even during a banking crisis. This result is in line with the implementation of banking regulations such as Basel III, which aims at not only, but this is one of the objectives, to reinforce the financial position of banks in terms of capital and liquidity. To conclude, we are able to show that both the nationality and the industry of the borrower matters when banks take their lending decision, especially during a banking crisis. This gives us a clue to understand how banks take their lending decision. In addition, financial institutions with a better financial position, we show that this financial institution is better able to sustain credit supply. So altogether, these results can contribute to develop efficient measures to limit the confidence crisis and to decrease the risk of credit crunch and its impact on the economic activity. Thank you very much for your attention.